Good afternoon, everybody, and welcome to this joint ShareSoc and Yellowstone webinar on Lloyd's Banking Group. And I think we have well over 100 people registered today, so that's terrific.
Excellent. Thank you very much indeed, Cliff. And good morning, everyone. Welcome and thank you for joining our ShareSoc webinar today. I'm Douglas Radcliffe. I'm the Group Investor Relations Director at Lloyd's Banking Group. As Cliff mentioned, also here with me today, we've got Carla Antunes da Silva, our Group Strategy, Corporate Ventures and Investor Relations Director. She's also on our Group Executive Committee. And Fiona Cannon, our Group Sustainable Business Director. We are delighted to once again have the opportunity to present to you. And given the current environment, we're again using a virtual format. We're keen to ensure that our retail investors have access to senior management and are able to raise questions on our business. And today's event follows on from previous events we've done with ShareSoc and another virtual shareholder event, which we actually hosted just a couple of weeks ago in conjunction with our AGM. Carla will first provide a bit of a strategic update on the business, with Fiona presenting to you on helping Britain recover and what it means to us. I will then run through our recent Q1 financial performance, and after that we'll open up for Q&A. But Carla, Fiona and myself will be very happy to take any questions you might have. And as Cliff has said, you can submit those questions through the Q&A box on the Zoom screen. I do hope that you will find the session both interesting and useful. So let me hand over now to Carla, who can give you an update on our strategy. Carla joined the group back in October 2015 and was instrumental in leading our 2018 to 2020 group strategic review, as well as our latest plan, Strategic Review 2021. So Carla, over to you.
That would start to help. Thank you, Douglas. Thank you, Douglas, and welcome all to today's. I was just saying that I'll give you first an overview of our strategic progress, and then I'll introduce you to the Strategic Review 2021 that Douglas talked about. And then Fiona will then give us a deep dive into helping Britain recover before I come back to update on the recent strategic developments. So let me start with a bit of an introduction to Lloyd's Banking Group. Many of you may know, but we are the UK's largest financial services provider. We have 26 million customers across our different businesses. So that's retail, commercial banking and insurance. We've also got the largest branch network and digital bank in the UK, and we're present in every community. That is obviously very, very important in supporting our purpose of helping Britain prosper. Our strategy is a distinctive one. It focuses on differentiated, multi-brand, multi-channel customer propositions. We have a market-leading efficiency. We have rigorous execution and management discipline and a prudent and low-risk approach to capital allocation and investment that sustains our competitive advantages, and we plan to stay that way. We've got strong market shares across our products. We're number one player in mortgages, and we have a fifth of the market. We're number one player in credit cards, again with a 25% share. We're also number one in personal current accounts with 22% share. Despite that, we still have growth in targeted key segments, and I will talk about those later. In wealth, for example, our share of 2% is well below our average market share of 19%. And through our Schroders Personal Wealth joint venture, we aim to become a top 3 financial planning business by the end of 2025. We're also the only bank in the UK with a full-scale insurance business through Scottish Widows. And this unique bancassurance model positions us well to take advantage of structural demographic changes, as well as market share growth opportunities in insurance and wealth. We turn to the next slide. We've come a long way over the past decade. If you think back, since 2011, the group's business has significantly transformed, and we've successfully shifted our focus from one of restructuring to one of selective growth and investment. The execution of this period has created clear competitive advantages. And in addition to significant improvements for customers and colleagues, we've also delivered for shareholders across a number of areas. 2020, to Douglas's point, was the final year of our most recent strategic plan, GSR3, which was launched 3 years before that in 2018 to transform the group for success in a digital world. Despite our external environment changing significantly during the period, we achieved the majority of our targeted outcomes, with outperformance in a number of areas underpinned by record investment of nearly £3 billion to enhance customer experience accelerate digitization and transform our ways of working. During this period, we strengthened our position as the UK's largest digital bank, with 17.4 million digital active users and 12.5 million mobile app users, both of which have grown at pace over this period. Importantly, the growth in these channels has also been matched by an increase in customer satisfaction, which we're very proud of, as we responded effectively to changing customer preferences. We increased the proportion of our products that originate through digital channels from 68%, a very high level already, to 85% today. And the growth in our digital channel has enabled us to compete effectively with new digital-only challenges. As you know, 2020 was a year of significant change for both society and the economy as a result of the pandemic. We've also seen a significant acceleration in longer-term strategic trends in our sector, including the move to digital and to further digitization. While change of this scale undoubtedly creates challenges, and the path to recovery for the UK will not be straightforward, the foundations we have, we believe, positions us very well to rise to these challenges. And we want to take a leading and transformational role in many of the opportunities that we think change creates. Hence, earlier this year in February, we launched the next evolution of our strategy, what we call the Strategic Review 2021. There is a video which will give a flavor of the vision for this, and that's available on our website if you want to watch that, or if you've had the chance to watch that before. And there you will find a significant amount of additional financial and other information on our group. You will also see many of our executive team talk about the priorities there. So what Strategic Review 2021 is, it's a combination of clear execution outcomes for the coming year, underpinned by the long-term strategic vision and supported by significant strategic investment, which is something which I've talked about before. Strategic Review 2021 will deliver meaningful improvement for our customers and colleagues. It will also support the creation of sustainable shareholder value through revenue generation and diversification, further efficiency gains, and disciplined growth. In Strategic Review 2021, we will accelerate our transformation to build the UK's preferred financial partner. And the following points are key. First, our purpose of helping Britain prosper is more important than ever. In Strategic Review 2021, we have centered the effort on helping Britain recover, supporting our customers' financial health and resilience through the areas of focus that are fully embedded in the business. Second, across our core businesses of retail, insurance and wealth, and commercial banking, we are bringing together more alignment to make sure that we are unlocking coordinated growth opportunities. This will be supported by further enhancing our core capabilities that enable sustainable success in the new environment, specifically technology, payments, data, and our people, the so-called enablers. Third, Strategic Review 2021 includes a clear execution outcomes for the year. They've got long-term vision in each area, and the priorities are built on our transformation to date, and will continue to be the foundations of our success long into the future. To give you a framework in each of our 2 customer segments and 4 capabilities, we lay out our opportunity, our areas of investment for 2021, and some of the examples of what you can expect us to be doing in how we're measuring the success this year and beyond. Our aims will be supported by significant levels of strategic investment. And together with our execution credibility, Strategic Review 2021 will thereby ensure that the group continues to build momentum during a period of management and environmental change. On this point, I should flag that Charlie Nunn will join us as our new Chief Executive in August. Charlie joins us from HSBC, where he was Global Head of Personal Banking and Wealth Management. And in the meantime, William Chalmers, our CFO, is running the business as interim CEO and ensuring momentum is maintained. Now, let me hand over to Fiona to give you more insight on the group's purpose and how that now more than ever is at the heart of our strategic plans. Fiona is the Group Sustainable Business Director, somebody I work very closely with and has ownership of our responsible business, environmental sustainability, and inclusion and diversity activity. Fiona, over to you.
Thank you, Carla, and good afternoon, everybody. Our purpose, as you've heard, is to help Britain prosper, and we've historically held ourselves to account through our Helping Britain Prosper plan, which was launched in 2014. And the plan looked to address some of the social, economic and environmental challenges facing the UK. It was actually a unique undertaking at the time, as the plan took us beyond business as usual and moved us on from what you might call a traditional CSR approach to responsible business. I think it's true to say, however, that the plan sat alongside the business rather than being completely embedded. With SR21, purpose sits right at the heart of the strategy, and that's a step change in our approach. And the expectations, of course, of large corporates are shifting, with 2 in 3 consumers thinking that businesses should be doing more to help society and the environment. And that figure is actually even higher for younger generations, particularly when it comes to their expectations of their own employers. And these societal and environmental challenges will increasingly shape the environment in which we operate. And while these challenges predate COVID, the pandemic, of course, has sharpened the attention on both, creating increased expectation of action. And this is where having a clear single purpose across the organisation is our strength, and why we are continuing to put our purpose of helping Britain prosper into practice, but with an immediate focus in 2021 on helping Britain recover from the pandemic. First and foremost, this is about helping households and businesses across the UK to recover and grow, but it's also about building the kind of economy we all want to be part of. And while our approach to helping Britain recover has many similar themes as helping Britain prosper, it also represents an evolution. In particular, under our Strategic Review 2021, we're embedding our purpose across all of our activities and decisions. And we see this both as an opportunity and an imperative for the group to get ahead of the key challenges in our society. Through our Strategic Review 2021, we have sought to evolve our approach to purpose so that it becomes a driver of strategic decision making. This enables us to deliver business benefits as well as increasing our contribution to society. For 2021, we've made a number of commitments under 5 core themes: supporting households' financial health and well-being, supporting businesses to recover, adapt and grow, expanding the availability of affordable homes, supporting the transition to a low carbon economy, and building an inclusive society and organisation. And these commitments will help ensure we contribute to creating an environmentally sustainable and inclusive future for the UK, and by doing so, build a successful and sustainable business. Before I hand back to Carla, I would just briefly like to look at how we've already started to make progress in 2020 and how our purpose and focus on helping Britain recover plays an important role in how we look at ESG issues. And so on this next slide, I'd like to call out a couple of key areas here. The first being climate change and the environmental challenges we are facing. With recovery comes an opportunity to build a greener future, creating new businesses and jobs. And we want to play our part in supporting the transition to net zero, and are committed to working with customers, government and the market to help reduce the carbon emissions we finance by more than 50% by 2030, on the path to net zero by 2050 or sooner. And we have recently become a founding member of the Net Zero Banking Alliance in support of that goal. We'll continue to develop propositions for our customers to assist in their personal transition to a lower carbon, adding to our existing products, such as our energy saving tool, helping customers improve the energy efficiency of their homes, and the fuel tree is decision tree, which helps customers understand whether their lifestyle is best suited to an electric or hybrid vehicle. Another significant priority to call out is our commitment to build an inclusive society and organisation, as we believe that the economic and social recovery should be one that's truly inclusive and involves communities across the UK's nations and regions. By having this built into our purpose, which is in turn embedded within the organisation, it will help us to build an inclusive society through our financial services offering, as well as to continue to build on the progress we've made to create an organisation that reflects the society we serve. And this is underpinned by our new aspirations for a leadership team of 50% women, 3% Black and 13% Black, Asian and minority ethnic colleagues in senior roles by 2025. Now, the focus on inclusivity is not only limited to our own organisation, but on our role in building an inclusive society through the provision of our products and services. And as such, in 2021, we aim to support financial inclusion by providing banking for groups of people experiencing homelessness, financial and domestic abuse, modern slavery, and to support the prisoner banking programme. We have already established a financial and domestic abuse team and formed partnerships with key charities to assist in the education of our customer-facing staff on how best to assist victims. These commitments to both the social and environmental elements of society enable us to truly assist in helping Britain recover. And I'll now hand you back to Carla to update you on recent strategic developments. Carla, back to you.
Thank you, Fiona. It is very early days, but in Q1, I hope you've heard we've delivered progress against a number of our priorities. And I hope you will also agree that in helping Britain recover, as you've heard from Fiona, we have made meaningful progress across the 5 priority areas that we've embedded in our business ambitions. Achievements to date, launching the Pay As You Grow and our recovery loan scheme to support clients through the next stage of their recovery where required. We've also lent nearly 4 billion to first-time buyers in the first quarter of 2021. And as Fiona mentioned, we joined as a founding member of the Net Zero Banking Alliance as part of our commitment to help accelerate the transition to a low carbon economy and to achieve our net zero by 2050 ambitions. The customer ambitions focus on further business alignment to help unlock coordinated growth opportunities across our core customer needs. Let me give you a few examples of what we've achieved in Q1. In Q1, we built upon the group connectivity of our insurance and wealth franchise by significantly increasing Schroders personal wealth introductions and by launching a new Halifax branded protection product, the latter increasing direct-to-site volumes by 25% year on year. For our commercial clients, we've launched new and exciting propositions in line with our investment focus on increasing digitization while also building our product delivery functions. Examples are outlined on the slide. Finally, we are investing in our core capabilities, technology, data, payments, and our people to enable sustainable success. We're encouraged by our early progress in 2021 and will continue to provide further updates later in the year as we report. I will now hand over to Douglas to talk through about our recent financial performance. Douglas.
Thank you, Carla. So looking at our financial performance, effectively, we delivered solid numbers in the first quarter. Net income of 3.7 billion was down 7% year on year, given lower rates, but an increase of 2% versus the last quarter of 2020. Net interest income, that's largely the interest earned on our lending book, was flat quarter on quarter, but if adjusted for day count, it would have actually been up 2%. Both net interest margin and average interest earning assets were both ahead of expectations. In a challenging environment, the group continued to demonstrate cost discipline, with total costs down 2% year on year. Pre-provision operating profit of 1.7 billion was down 12% year on year, but up 21% compared to Q4, given the increased income and lower costs. Asset quality remains strong, with underlying credit experience benign. The improved economic outlook has driven a provision release of 459 million, resulting in a Q1 impairment credit of 323 million, which I'll explain more fully later. Statutory profit before tax of 1.9 billion was up significantly, both year on year and versus Q4. The group's capital position also remains strong, with a CET1 ratio of 16.7% after 54 basis points of capital build in the quarter. So turning now to look at how the group's customer franchise performed in the first quarter. We saw another quarter of strong mortgage book growth, with open mortgage book balances up 6 billion in the quarter, building on the trends we saw in Q4. Given the continuing strength of activity levels, we expect further open book growth this quarter, with a somewhat slower pace in the second half. As expected, given the continued social restrictions during the quarter, consumer finance balances were down 0.8 billion to 36.2 billion. Modest growth in motor was more than offset by the reduction in the credit card and unsecured loan books. In commercial, balances were broadly in line with December. A small pickup in SME balances was partially offset by continued optimization in large corporates. Given the strong mortgage volumes seen to date, and assuming a gradual pickup in unsecured balances in H2, in line with our macroeconomic assumptions, we now expect low single-digit percentage growth in average interest earning assets this year. On the other side of the balance sheet, Our retail deposits were again a strong growth area, up more than 9 billion in the quarter, including current account growth of 5.6 billion. This continues to demonstrate the strength of our franchise in a still subdued environment. In commercial, we have continued to see a small tick up in SME and mid-corporates deposits, whilst large corporate balances have stayed relatively stable. Looking further at income, net interest income of 2.7 billion in the first quarter was in line with Q4, as I said earlier. The Q1 margin of 249 basis points was up 3 basis points on Q4, benefiting from continued optimization activity in the commercial book, strong customer inflows, and lower funding costs. Mortgage growth was the primary driver of the growth in average interest earning assets in the quarter. With the benefit of Q1 developments and an improved yield curve environment, we have upgraded our guidance and now expect net interest margin to be in excess of 245 basis points for 2021. Other income across divisions continued to be impacted by lockdown restrictions in the UK, albeit up 6% on Q4, given the non-recurrence of negative insurance one-offs. We continue to expect gradual recovery in the second half of the year as activity recovers. We also continue to invest in income diversification opportunities over the medium term. So looking at operating costs, which continue to provide competitive advantage. Our focus on efficiency and cost discipline continues to provide competitive advantage and remains fundamental to our business model. In the first quarter, total costs were down 2%, with a reduction in both operating costs of 1% and remediation costs of 25% versus Q1 2020. Looking forward, remediation costs are likely to be somewhat higher than the Q1 run rate. We are currently awaiting further information in relation to HBOS Reading and the outcomes from the independent panel re-review. We deeply regret the distress that victims of the crimes committed at HBOS Reading have experienced and are determined to put things right. Our track record of ongoing sustainable cost savings has enabled continued investment in the business. Looking forward, we continue to expect full year costs to be lower than 2020 at circa 7.5 billion, despite COVID-related headwinds and expected increased variable remuneration costs. As I mentioned earlier, asset quality remains strong, with very stable observed credit experience in the first quarter. Retail credit experience was benign and in line with pre-COVID levels. In commercial, we have seen improved outcomes on restructuring cases, lower defaults, and reduced balance sheet exposures. Furthermore, the macroeconomic outlook has improved since year-end. The vaccine rollout in the UK and additional government support announced in the spring budget have resulted in positive shifts in our economic assumptions. IFRS 9 accounting requires us to reflect expected future credit losses based on our economic expectations. The main drivers of impairment charges for us are GDP, unemployment, and house prices. As you can see, our provision actually reflects a range of economic scenarios, including our severe downside, weighted at 10%, which assumes peak unemployment of 10.4% in Q4. Our base case, weighted at 30%, now assumes peak unemployment 1% lower at 7% versus 8% previously, and HPI now expected to reduce by around 1% in 2021 versus circa 4% previously, compared to our Q4 base case. The improvement of those economic expectations resulted in a 459 million provision release in Q1. Together, the benign underlying environment and macro improvement result in a net credit of 323 million for impairment in our income statement, as we have reduced provisions. Our total expected credit loss provision of 6.2 billion remains around 2.2 billion higher than at the end of 2019. This provides significant balance sheet resilience and protection against future credit impairments. Given the updates this quarter, we now expect the full year 2021 net asset quality ratio to be below 25 basis points, although needless to say, uncertainty remains on the outlook. Credit quality remains strong across the book, with both retail and commercial portfolios performing well. In retail, we continue to see low new to arrears levels across the business, at or below pre-crisis levels. Notably, this is despite the vast majority of payment holidays now ending. 95% of all retail payment holidays have now fully matured, with 94% of these customers resuming payment. Of the remaining 6% in arrears, around half of those were already in arrears before the payment holiday was granted. Within the commercial portfolio, our exposure to the sectors most impacted by coronavirus continues to remain modest, at around 2% of group lending. Around 70% of the commercial banking exposure is at investment grade. Across the portfolio, our new business support unit volumes remain in line with pre-crisis levels. Looking forward, we do expect new to arrears levels to increase later this year, consistent with our economic outlook, as support measures subside and unemployment increases. We are, however, well provisioned for this. So in summary, we have supported customers since the start of the pandemic and will continue to support them throughout the recovery period. We will deliver across our Helping Britain Recover focus areas and contribute to the transition to a more sustainable and inclusive society. We have seen solid financial performance in the first quarter as the business continues to deliver, with balance sheet momentum and income growth versus Q4. We have also continued to build our strong capital position with a CET1 ratio of 16.7%, comfortably above our regulatory requirement and internal target. I'm sure you're keen to know what this means for dividends. We are very aware of the importance of dividends for our shareholders. In the quarter, we accrued 5 basis points for dividends, in line with the 2020 payout and consistent with regulatory guidance. We will update the market on interim payments with the half-year results when we have received greater clarity on distributions from the regulator. The board remains committed to future capital returns and in 2021 intends to resume our progressive and sustainable ordinary dividend policy at a dividend higher than the 2020 level. As Carla indicated, Strategic Review 2021 is underway and is delivering momentum on key initiatives, all of which will support our trajectory to a medium-term statutory return on tangible equity in excess of our cost of equity. Given our solid start to the year, we have enhanced our 2021 guidance. That concludes our presentation for this morning, well, indeed for this afternoon. Thank you for listening, and we are happy to take any questions. As a reminder, if you would like to ask a question, please type it into the Q&A box on your screen and we'll address them one by one. I have actually noticed that when I've actually been going through and presenting, a number of questions have already come in, but please do submit any further questions and we'll try and get through them as we can. The first question, I'll go through these. They're in no particular order, but we'll just run through. So the first question actually relates to future growth of the organisation. Given our focus on the UK, a question has been raised about where the future growth is likely to lie. Carla, would it be possible for you to address that question, possibly?
Yes, and I'm assuming there's 2 parts to that, or at least I'll answer that with 2 parts. One, will we continue to grow from the UK? So that's a geographical, and then I'll answer also where I see growth areas. So turning to the first on the geography part, as you know, throughout the last 10 years or so, there was a very big effort to restructure the business and to focus back to the UK. That will be and continues to be the focus area. Helping Britain prosper, with our focus more recently on Helping Britain Recover, will continue to be our focus, and we do not intend to change that. So that's the first part. The second part with growth areas, I'll start with the largest product and asset that we have in our balance sheet are mortgages. And over the last, it started probably about 9 months ago, we've seen very strong growth and continue to see strong growth on the mortgage book. So you'll actually see what Douglas was explaining was that we've started to have very strong balance sheet growth, otherwise sometimes seen as average interest earning assets, which tell you what the customers are doing. We also expect to start to see growth come back once lockdown measures start to be removed. So we've started to see interest coming back through our commercial book, although some business decisions and investment decisions are still being held back. We've started to see some spend come back in terms of debit spend, maybe not so much on credit spend. So we actually expect more growth to come through once lockdown measures are fully lifted. And one of the other priorities from growth as well is to diversify our income streams. So again, if I turn to our businesses like insurance and wealth, where we expect to see increasingly the benefits from our Schroders Personal Wealth JV that I've mentioned. So that should also be another area of growth as we go through. And what we can see is coming out of the crisis, people have got more savings because they've not been able to spend. So you saw nearly 40-something billion of deposit growth. So the question then becomes, what do they do with that? Do they decide to save more for the future? Will they spend that? Or will they actually, for instance, turn that into future pensions and investments and other businesses? So we hope to also get some growth coming out of those deposits that we've attracted in our franchise growth. I hope, Douglas, that answers the question of our growth opportunities.
That's great. Thank you, Carla. One's come through here from for Fiona, actually. It's actually relating, Fiona, to Scottish widows and ESG, particularly the environmental ambitions. And you may disagree with some of the way that the question has been asked, but the question is why is divestment considered more effective for forcing improved corporate ESG than engagement? The risk is allowing less ESG-minded investors to buy these companies or even privatize them. Would it not be a better policy to engage and help corporates improve their ESG actions and therefore raise their valuations and have a positive impact?
Thanks, Douglas. So I guess the answer is that we're doing both. You're right. I mean, we absolutely need to support our clients as they're transitioning to a low carbon economy and make sure that they have the plans in place in order to do that. And that's very much a focus in terms of the activity that we're undertaking, working very closely with our clients and providing support for them. So, for example, we have developed a carbon a calculator for our large corporates and for our for our large property developers, in order to be able to work out what the energy efficiency is of their buildings and therefore be able to kind of support in that way. So absolutely, we need to be able to focus on engaging. But I guess the point about divestment is really where we feel that companies are failing to meet our ESG requirements once we have put into place some of those engagement activities. And at that point, we feel that actually we really do need to take action there. So, for example, we've committed to not directly financing new or existing UK coal-fired power stations by the end of 2022, which is 2 years ahead of the government's 2024 phase-out target. But I think the point is well made that we need to be doing both. It's not or either or.
Excellent. Thank you, Fiona. There's also another question in here, which is actually about the group's dividend policy and management approach to the mix of buybacks and dividends when it comes to shareholder distributions. So let me just provide a little bit of context around that. So when we look at the 2019 dividend decision, that was taken by the board at the request of our regulator, so alongside our peers. So in February, we announced the return to dividends with a return of a dividend of about 404 million, which equated to 0.57p per share. That was actually the maximum that we were permitted to pay by the PRA. In the December announcement, the PRA indicated that they would update their guidance on dividends before the half-year results. Now, clearly, our half-year results are at the end of July. I mean, what I would say is, look, the board fully understands the importance of dividends to our investors, and the group actually has a strong track record of returning excess capital to shareholders. Indeed, if you look at it at the moment, our capital position is 16.7%, and that's significantly in excess of both the regulatory requirement, which is around 11%, and indeed our own capital requirement, which is around 13.5%, so significantly in excess. So look, the board is already accruing for dividends. We accrued in the first quarter, and we intend to resume our progressive and sustainable ordinary dividend policy during 2021 at a level that's higher than 2020, and we'll update the market at the half year subject to regulatory guidance. I mean, what I'll do is very much state there as well, I should add that it's normal policy to actually consider the repatriation of excess capital and capital returns at the full year. So I suspect that policy will be approached, will again be approached this year. Now, when you look at it from almost like a buybacks and special dividends, that's when I talk about earlier about the excess capital repatriation. Clearly, we're looking at the progressive and sustainable ordinary dividend, but even once you've announced a progressive and sustainable ordinary dividend, given the capital ratios that we have, you would expect there potentially to be some form of excess capital repatriation. And as I said already, the board is very keen and understands the importance of returning that excess capital to shareholders. We have in the past carried out share buybacks. We did about £1 billion in 2017-18, when the board viewed buybacks as essentially a compelling or a good way of creating and compelling shareholder value. And the amount of capital returned was large enough to do that. Now, the actual form of capital return, which I'm sure is of interest to you, is a decision for the board, will probably be made at the full year. And it will be made after we've got the PRA clarity. It'll be made on the context of business performance. It'll also be in the context of different shareholder requirements, because we're quite conscious that across our shareholder register, there are different requirements, whether it comes to retail shareholders, institutional shareholders, whether you're looking at income holders or whether you're looking at value shareholders. So the board will take that into consideration, looking at the range of different requirements and looking at the situation at that point in time. Excellent. Okay, moving on to the next question. There was a question on impairment, actually. Can you please tell us what sort of through the cycle impairment charge is reasonable to expect for Lloyds? Is 15 basis points the right area, please? I'll probably guide towards that. I think 15 basis points would probably be a little bit low. If you're looking at it from this year, clearly we updated our guidance that we expect it to be less than 25 basis points for the year. Clearly, it will depend on the economic environment and how it moves through the year. We used to, well, probably when you go back to our previous group strategic review, we talked about a through the cycle impairment charge of around 35 basis points. So in the absence of anything else, I'd say that's probably a good gauge. As I said to you already as part of my presentation, I mean, frankly, at the moment, credit quality is remarkably benign, and we're seeing very little coming through at all. And a lot of that will be due to the prudence and the conservative nature of our lending book. And it will be very interesting to see, almost like post-crisis, whether those through the cycle numbers change. But I think in the absence of anything else at the moment, I think I'd probably guide more towards the around 35 basis points where we were pre-crisis. Okay, moving on to another question. Okay, there's actually a question here on branches. And how do you see the role of branches, and are you going to continue to reduce the branch network? Carla, is that one that potentially you could address?
Yeah, happy to, Douglas. So for us, branches are a very important part of our multi-channel strategy. I think I mentioned that as well in my presentation. But we can't be blind to see our customer changing needs, and that also we need to adapt to those in terms of approach. So we have not had a target for branch closures. You haven't heard us say that in the past. In fact, what we've had is a target, which we have reiterated, which is we will remain and we will maintain the largest branch network in the UK. We've been announcing some branch closures. Admittedly, our peers have closed at a faster pace than we have, and they've announced more. But some of those closures were paused during last year and during the sort of peak of COVID 2019 pandemic. So it is fair to say, and also with Fiona here, in terms of when we think of the impact of branches, we think of the impact of branches also on our communities, the impact on our vulnerable customers, and the impact that this does, especially for customers also who come in because they've got more complex needs and they need to sort of think about having that personal human touch in terms of making those decisions. So we don't take these lightly at all. We also always think about the alternatives that we have for our customers when we think of closing branches network. So we think about distance to the next branch network, to the next branch we have, access to ATMs, etc. And we have continued to invest quite significantly in terms of our branch network. So we have a number and a series of flagship branches where you've got, training on digital skills, where we do a lot to do with the local communities in terms of business networking and having that link with the local presence. And we also were very early on in terms of mobile branch network and the ability to roll those through. So if you think about our branch network, it is a part of a broader and more complex multi-channel strategy, which we will remain. We are the largest digital bank, but we do not want to be a digital-only bank. We are also, what we've seen over the last year is that things like this with video conferences, etc., work well, and our customers are actually asking for that. So we can see a world where we will be able to actually offer that personal touch, but through different means of communications as well. But what's fair to say is that the branch network has been used less. Even post-opening, we're not back to where we used to be. So there has been a structural shift to how our customers use branches, Douglas. And that will mean that we will probably have less, but still remain the largest branch network in the UK.
Excellent. Thank you, Carla. Okay, we have another question, which is, what share of total income do you think will come from non-interest income in the future, please? So let me touch upon that first of all, just looking at other income. So other income in the first quarter was about 1.1 billion. It's quite clear that our other income line has been impacted by the COVID crisis and has been impacted by activity levels across all of our businesses, actually, whether that be retail, whether that be commercial, or whether that be insurance operations. We previously indicated that actually we think that actually there's probably been about a 300 to 400 million impact of COVID on other income, over the course of a year or so. So we would absolutely expect there to be a recovery in other income from activity, and as we start to come out of the current lockdown and the environment that's there. In addition to that, we have been investing quite significantly in a number of areas to actually increase the level of other income. So whether that be looking at some of the insurance propositions, whether that be looking at wealth management, where we've now got a joint venture in conjunction with Schroders. One of the reasons we're investing in a number of these different areas is because actually they provide more of an annuity flow of other income in the future. So we would expect that line to grow. Now, your question was actually related to what share of a total income you thought other income would comprise. Now, if I look at the first quarter, so the first quarter we had probably about 1135 million from other income. We had about 2677 million from net interest income. So if you look at Q1, the split is broadly 30-70. Now, I've said the drivers that you've got from another income perspective. If you look at it from a net interest income perspective, there's a couple of other areas that will drive growth. Carla's already talked about them, some of the product areas and how we can grow balances going forward, whether that be mortgages, whether that be unsecured and different growth opportunities that lie. Clearly the big element when it comes to net interest income is the interest rate environment. Clearly, in the current low interest rate environment, that is not optimal from a bank being able to manage margins both on assets and liabilities. If interest rates start to increase going forward, then it provides much more flexibility to manage that going forward. And you would expect ultimately that the optimal environment for a bank from interest rates is probably more like around the 2.5% to 3%, because it gives you the optimum way to manage both assets and liabilities. So what I would say is the NII line is very much dependent on how the interest rate curve, the yield curve changes going forward. So I'm not going to give you a specific proportion of other income, but what I would say is that there are opportunities from both an other income and an NII perspective. Okay. Next question that came through on the list was, can you talk about your target CET1 capital ratio and the time frame over which investors should expect the group's ratio to reduce it, please? So I've touched upon some of that already just in the presentation that I made. Clearly, when you look at it at the moment, the actual regulatory requirement at the moment when it comes to capital is around 11%. If you look at our overall general target for capital, it's the 13.5% or around 13.5%, which is the 12.5% plus a management buffer of around 1%. So when you see where we are at the moment of the 16.7%, clearly we are significantly in excess of our capital requirements. Now, as I also mentioned in my presentation, and indeed one of the previous answers, the board will look primarily at the full year on repatriation of excess capital. At that point in time, they'll have to take into consideration a number of factors. What's the performance of the group? What's the future performance of the group? What's the regulatory environment as it stands at the moment? Are there any regulatory changes likely to come through over the next few months? Just as an example, we know that there are going to be a number of regulatory changes coming through at the beginning of next year that will increase our risk-weighted assets, and we've already flagged that. So I think the board will need to take into consideration both trading performance and the regulatory environment, and indeed we need to get clarity from the regulator as to what we can actually pay from a dividend perspective. But I would certainly hope that over time we are able to bring down the capital ratio closer to our target and repatriate some of that excess capital. Another question that came through, and this is sort of linked, actually, Carla, this might be one that's just worth touching upon. I think you touched upon some of it in your growth question or future growth already, but the question that's come through is, what do you see driving loan growth in the next decade beyond mortgage and credit cards?
Yes, so I think that what we're seeing is a combination of whether you end up having structural changes as well. So let me start with a personal, so with the individual customer. For us, the key question, which we don't know yet, is whether people will go back to the spending habits they had pre-COVID. And currently what we have is a savings that has never been as high. So you've seen numbers and they're often quoted, but personally, we've seen nearly 50 billion pounds of additional savings. And do people go back to spending those? We've seen actually, so on one hand, you can say that some of those savings are ending up in the housing market because people are deciding that their home is a more important place, and they structurally also think they're going to spend more time, and hence they're making those decisions. And you could see some of the savings have gone back into that. What they haven't done yet, and it's not clear, is whether they go back to spending on credit cards, for instance, the way that we saw with bigger tickets being bought on credit cards, whether you end up having then on spending as well other aspects with the likes of the buy now, pay later, which has been areas of growth that we have not participated in because we've decided that that's not where we want to participate from a risk point of view, but you could see some of those areas come in. And also then we have a structural change which fits into Fiona's world, which is in terms of lower carbon emissions. We're also seeing a significant change in terms of the fleet and in terms of our fleet business and leasing. So whether people will have to change and want to change their cars because they don't want to have the non-carbon efficient. So that would be on the individual side. On the corporate side, many of these companies who essentially on the large corporate, they raised a lot of capital. They've been cash rich, have that on their balance sheets, and they're holding back on investment decisions. So do those come back? Do then they issue or do they borrow? I think issuance will continue. So I think that's where you're likely to see, and they'll be more in tune to having fee income if we do more business with them. And whether the SMEs and the small, medium corporates and the businesses, whether they also feel more comfortable about making those investments and having more working capital. So I think it will go back to exploring areas that are not so at the core, so not so much with the sort of traditional mortgage, etc., but actually exploring new areas of growth because of structural changes to society. That's where you tend to have those bigger growth aspects. But Fiona, maybe it is worth sort of commenting on some of that growth area as well with the ESG lens, especially on the sort of motor vehicle aspect, because I think that's quite an interesting area.
Yeah, no, you're right, Carla. I mean, that is an area that we're seeing real growth in. Of course, the issue that we face into there is one of the reasons why we've said that we're working with helping to reduce the emissions by working with the market and the government, is that there are some structural issues to us being able to go as far as we might like to. So, for example, around charging points, and so that really will require us to work very closely with the government and look at some of the policy decisions that really need to be put in place to be able to support that. But certainly what we're seeing is you know, a lot of interest from our clients now around the salary sacrifice idea, where people sacrifice some of their salary to pay for a hybrid vehicle, and that's starting to grow in terms of interest and the number of people taking part in that as well. And so this feels like a real tipping point. There'll be a point at which the infrastructure is in place, and the interest is certainly there from consumers in a way that it is less so at the moment around green mortgages, for example. And so that's what we're really working towards, is to be ready for that real inflection point, because we see that this is a real growth area.
Excellent. Thank you very much indeed. So another question. I'm conscious about time as well. So Kate, I'm not sure for the conclusion of the presentation how much time we've got, but I suspect that you'll want to do a little bit of conclusion and we can follow up with further questions. But let's cover off a couple more anyway. So we've got a question
until about 2 o'clock, Douglas. So we've got 5 more minutes until 3 o'clock. Sorry, so that's about 5 more minutes.
Okay, excellent. Thank you. So, as a bank registered in Scotland, how would Scotland leaving the Union and joining the EC impact on that status? Would it be necessary to re-register in England? So I think there's a couple of points when it comes to Scotland. And Carla, if there's anything further you want to add, please do so. I mean, first of all, what I'd say is that there's no referendum has been agreed as yet. So clearly it's probably too early to speculate on this matter as a whole. What I would say is we made extensive preparations for the 2014 referendum, and we'll have to revisit those plans if this does indeed materialise. We're proud of our Scottish heritage and indeed are committed to having a significant presence there. We're one of Scotland's largest private sector employers, with more than 13,000 employees based in Scotland, almost 20% of the total LBG workforce. And Scotland makes up actually about 10% of our group sales, with market shares similar to the group. And indeed about 15-16% of our senior management is actually based in Scotland. So in essence, look, we've got plans in place. We've been through these sort of exercises in the past. We've such an exercise would be costly, it'd be expensive, but our view would be that it would be our intention to fully support our staff and indeed our customers throughout the process of any potential referendum and any outcome that would come through. Excellent. Okay, so another question is, this might be one coming down your way actually, Carla, because it's relating to the multi-brand, multi-channel approach. So the question was, further to high street branches and brands, I have two banks on my high street. One is Lloyds and the other is Halifax. I have accounts with Bank of Scotland and Halifax. There is a lot of overlap in products between group companies. What are your plans to streamline this situation?
So that's a very good question, because multi-channel is really at the heart of how we've given and made conscious choices around customer proposition. So we look at this topic all the time, as you can imagine, as an executive team, and we make sure that there is sufficient differentiation between offerings, but also in terms of our customer base. And what we found is that despite the move towards digital, and that's been a general secular move and one that we think structurally will stay, there is a very different segmentation aspect to our different brands, and hence whilst that remains, that the multi-brand strategy will stay. In fact, multi-brand goes beyond what you see on your high street. So, you know, you'll have Cheltenham and Gloucester, so that will be the intermediary network that brand that we use, and that will be something that is very recognized, has had lots of plaudits, and frankly, it gets 5-star ratings from the intermediaries in terms of our mortgage distribution. Obviously, we now have our Schroders Personal Wealth brand as well, that sort of is also used and linked to our Lloyd's branding. So I think whilst the segmentation aspect works, which clearly we see that as information in terms of our data, in terms of the way that there is a differentiation, that makes sense. But your question is a fair challenge. And I think as an executive team, what we need to make sure is that you get the economies of scale and the ability to have that in the sort of what we call the plumbing behind the scenes, but then the front customer experience has got that differentiation. But this will continue to be a key aspect of our offering, and it's one that we feel that as a group really makes sense to target the different customer base. When you cover nearly a quarter or more of the UK population, you are appealing to very different groups, very different age groups, very different segmentations, they're very different aspirations and ambitions. And we think that the multi-brand offering covers that in the best possible way.
Excellent, thank you, Carla. I'm conscious about time. There are a few more questions remaining. What I would propose is, if any individuals do have those burning questions that they would like asked, and indeed would like a direct response, then by all means either email ShareSoc or indeed email myself in the investor relations team at Lloyds, and I'm very happy to get back to you with those specific questions. But given the time, I think we probably ought to cut the questions short there. And Kate and Cliff, I'm not sure whether you want to conclude.
Yes, thank you so much to Douglas, Fiona and Carla for the presentation. And it does bring us to the end. Thank you to everyone who's attended today. As you leave, you're going to come to a short survey, and we would really appreciate it if you could complete it, as management really do value your feedback. If you have any further questions, like Douglas said, you can come back to us. Maybe if you want to email me at info@yellowstoneadvisory.com, and we can take it from there. And on screen, you're going to see a list of upcoming webinars that ShareSoc and Yellowstone Advisory are going to be running over the coming months. Both our websites have more information on all these events. And for those of you joining the Signet after meeting, importantly, the link is in your webinar reminder email. If you want to click on that, it will take you straight through to the after meeting. And I just want to say thank you to everyone for attending today, and goodbye.